Now let's have a look at how we can assess the objective of efficiency using the expense ratio. So the expense ratio is one of our two tools that we can use to assess the efficiency of the business. It's going to tell us how much out of every dollar of sales the business is spending on particular expenses. So in terms of calculating the expense ratio, we need the information from the income statement. They will give you the formula in the HSC, but it's simply expense over sales times 100. Because it's times by 100, we know that it is written as a percentage, and we're saying how much out of every dollar of sales we are going to spend paying that particular expense. Just be aware that they could ask you to calculate the expense ratio for the total of other expenses, for a particular category of expense, or any other individual expense on the income statement. However, if they don't specify, assume that they want you to calculate for other expenses. So let's have a look at how we calculate this ratio. Step 1, we need to identify the expense and sales figures in the income statement. Then we just need to use the formula to calculate the ratio. In this case, we know that it's going to be 120,000 of total expenses over our sales of 380,000 multiplied by 100. That's giving us a ratio of 31.58%, or the business is spending approximately 32 cents out of every dollar of sales paying that expense. Another way we could be asked to calculate this ratio is where they give us our sales and our profit figures but not the expense figure. So step 1, we need to calculate the value of expenses by rearranging the net profit formula. So we know we're going to rearrange that to get other expenses. It's just going to be gross profit minus our net profit, or our 170,000 minus our 80,000 in net profit, giving us other expenses of $90,000. Then step 2 is just the same as before. Use the formula to calculate the expense ratio. So we've got our expense over sales times 100, or in this case, it's going to be our $90,000 over our $300,000 of sales times by 100, giving us an expense ratio of 30%, or the business is spending 30 cents out of every dollar of sales paying that expense. When we're interpreting the expense ratio, we can interpret it based on previous results. So remember, the higher the ratio, the more the business is spending paying that expense, and so therefore the lower their efficiency. If it is higher than last year, that means the business is spending more than last year paying the expense and their efficiency has deteriorated. However, if it is lower than last year, the business is spending less than last year on the expense and their efficiency has improved. In relation to the industry average, if the expense ratio is higher than the industry average, that means the business is spending more than other businesses in the industry paying that particular expense, and so they are less efficient. However, if it is lower than the industry average, that means the business is spending less than other businesses on that expense, and they are therefore more efficient than other businesses in the industry. So how can the business improve the ratio? Now, there is no specific syllabus point that is talking about efficiency strategies. So what we need to be thinking about is to improve the expense ratio, we need to look at how we can lower the amount we spend on expenses. And the way that we can get syllabus content on that is to look at the cost control strategy of expense minimization. So we're looking at tools and ideas that can help us to eliminate waste and prevent unnecessary spending. This could be by finding cheaper suppliers, minimizing our use. It could be about outsourcing. It just depends on which expense you are trying to reduce. So in summary, we need information from the income statement to calculate the expense ratio. It's always written as a percentage. It's telling us how much out of every dollar of sales the business is going to spend on a particular expense. It may be calculated for the total of other expenses or for any other individual expense or category of expenses on the income statement. And typically, the higher the ratio, the less efficient the business is going to be because they are going to be spending more on that particular expense than they did last year or than comparable businesses.